Americans just hit a milestone. They are spending $250 billion every single year on pets. That number keeps growing. Should you be investing in this massive market? Most people ignore pet stocks completely. They focus on tech and energy instead. But here is what they miss. Pet spending grows faster than general inflation. It is recession-resistant too. Today you will learn exactly where the money flows. You will see which companies profit most. And you will discover if pet investments belong in your portfolio. Let us start with the numbers that shock most people. The pet market grew by $3 billion last year alone. Americans now spend more on their pets than on personal care. Think about that for a second. Your neighbor spends more on dog treats than deodorant. Millennials and Gen Z are driving this surge. They view pets as family members, not expenses. They spend money on pet insurance, grooming, training, and wellness. Premium pet food has become mainstream. A single bag costs $40 to $60 now. Veterinary services are a growth engine too. Pet owners visit the vet more frequently than ever. They choose advanced treatments. They get cancer therapies and orthopedic surgery for their animals. This is not a trend slowing down. Here is why this matters to your wallet. When consumer spending patterns shift this dramatically, investment opportunities emerge. Pet food represents the largest chunk of pet spending. It takes up nearly 30% of the total market. But here is the surprise. Veterinary services are growing 3 times faster than food sales. That is where the real profit margins sit. Companies like Virbac, Zoetis, and IDEXX Laboratories dominate veterinary supplies and pharmaceuticals. These are the names making serious money. Pet retailers like Chewy have transformed the game. They grew because they understood convenience. Pet owners order online now instead of visiting stores. Grooming and boarding services represent the second largest category. Local businesses capture this market, but franchise chains are expanding rapidly. Pet insurance is the fastest growing segment. Only 3% of pets have insurance coverage today. Imagine when that reaches 10%. The math is simple. More insured pets mean more vet visits. More visits mean higher revenue for clinics and pharmaceutical companies. This is where savvy investors see opportunity. Zoetis is the largest animal health company globally. They make vaccines, medicines, and diagnostics for pets and livestock. Their stock has outperformed the S&P 500 for 5 straight years. That is not luck. They have pricing power. Pet owners will pay whatever it costs to save their animals. IDEXX Laboratories manufactures diagnostic equipment for veterinary clinics. Every modern vet uses their machines. When you own the infrastructure, you own the market. Virbac focuses on animal pharmaceuticals and health products. They operate in 70 countries. Global diversification reduces your risk. Now here is the challenge. These stocks are not cheap. They trade at premium valuations. That means you are paying more upfront for future growth. Is it worth it? Historically, yes, but timing matters. Many investors wait for market corrections to buy. Consider looking at smaller cap veterinary service providers too. They offer higher growth potential with more volatility. This is where the unique opportunity sits. Direct stock ownership is not your only path. Exchange-traded funds focused on pet care exist now. They bundle multiple pet companies into one fund. This reduces your single stock risk. You get exposure to the entire industry. Real estate is another angle. Pet-friendly apartment complexes command higher rents. Pet grooming salons and boarding facilities are booming. Some investors buy the real estate these businesses operate from. They collect rent while pet spending grows. Think about this strategy. You own a building. A pet grooming franchise rents space from you. Pet owners spend more every year. The franchise business grows. Your rent increases. This is passive wealth building connected to the pet trend. Consumer staples funds that include pet care products offer stability too. These funds own established brands. They do not have the growth upside of smaller companies, but they offer consistent dividends. Your money grows while you sleep. Many investors combine both approaches. They hold a core position in stable pet care ETFs. They allocate a smaller portion to higher growth individual stocks. This balance matches their risk tolerance. Pet spending is resilient but not bulletproof. During severe recessions, people cut discretionary pet care first. They skip grooming. They delay vet visits. They buy cheaper food brands. This happened during 2008 and 2020. Stock prices fell, but the decline was smaller than the overall market. That recession resistance is the value proposition. Another risk sits in competition. Amazon is moving into pet supplies aggressively. They undercut prices. Traditional retailers like Petco struggle against this pressure. Your investment choice matters more than general exposure. You need companies with moats. Zoetis has a moat because vets depend on their products. Chewy has a moat because they built customer loyalty. A generic pet food retailer has no protection. Also consider regulation. Pharmaceutical companies face pricing pressure from governments. The FDA tightens rules on veterinary treatments. These headwinds impact profitability. Do your research on specific companies. Do not assume all pet stocks move the same direction. The strongest companies will continue growing. Weaker competitors will struggle. Your homework determines your returns. Here are your 3 critical takeaways. First, the pet industry hit $250 billion and keeps accelerating. This is not a bubble. This is a permanent shift in consumer behavior. Second, the best profits flow to companies with pricing power and recurring revenue. Zoetis, IDEXX, and Virbac lead for a reason. Third, you have multiple paths to invest. Direct stocks, ETF, or real estate all capture the pet spending trend. Now your job is clear. Research these companies this week. Check their earnings reports. Read analyst opinions. Build a position that matches your portfolio goals. Some of you should own these stocks. Others might prefer ETFs or real estate. The important thing is you now see this opportunity. Subscribe to Wealth Pulse for daily investment insights and consumer trend analysis that help you build wealth.